Okay, so we're back here. Um, we're going to cover now what we call the primary trend. And I refer to this as what I call non-negotiable criteria. And there's a few caveats to it. We're going to talk about that in just a second. But what you're trying to achieve here, and the type of trading that David and I do is momentum based, and which means that we're trading continuation patterns. When you look at the technical analysis, they're continuations of an existing trend. We're not trying to pick a bottom and figure out when a stock is going to go from a secular downtrend to an uptrend. We're waiting until it shows us some evidence that it's in an uptrend. And then from there, looking for some consolidation and then a continuation of that trend. There's some reasons behind that why we're doing it that way, and they make a lot of sense, and we'll cover those in just a little bit. But this is really just the maturation cycle of a stock's life. It goes through basically four stages. Stage one is a consolidation or neglect phase where there's not a whole lot of volume. Stage two is an advancing phase. That's where something changes with the prospects of the company, and you have a lot of money coming into it, institutional money. You'll see volume will pick up dramatically. And then the topping phase is where institutions are selling and they're starting to liquidate, and that's usually on the upside, or you get a sideways type of action. And then there's the declining phase, which is where the stock really breaks and starts selling off hard, and you get the exact opposite of the stage two. You get a stage four, so you're in a sharp downtrend as opposed to an uptrend. The reason why we want to be trading stocks that are in an uptrend is because, as we've talked about before, we've looked at the biggest winning stocks going back all the way back to the 1800s and taken a very scientific approach to that. If you go and you look at all these names that have made these big moves and these accelerated moves, 98 to 99% of them, virtually all of them, happened in a stage two uptrend. So if let's just say 98% of the biggest, fastest moving stocks happened in a stage two uptrend, well, do you want to be in the 98% club, or do you want to be in the 2% club? Do you want to have a 2% probability of finding a stock that's a big winner, or a 98% probability? Because if you're in a stage four and you're buying stocks that are in stage four, hoping they'll get into stage two, well, history argues that you've only got a 2% probability of, at that particular time, being in a big winner until it gets itself into a stage two uptrend. So,
Mark, I'd like to add, in each one of these stages, they're defined very, very clearly by price and volume and how the stock is acting and what's happening. The perfect timing to put up that chart. And I think the real goal of an investor, somebody who's following these methods, is they have to get into their mind a picture of what each one of these stages look like. And that's why it's so important to take the material that we're going over and then even do further research in looking at uptrends and stocks that have had big moves over the past, and study them. What do they look like in stage one? What does the volume and price action look like in stage two and stage three and stage four? So when you're going through the market, you're going through stocks, you can quickly identify which stage a stock is in. And that's something that they have to get really almost ingrained into their mind, a picture in the mind of what each stage looks like.
right. And this is what I call a qualifier. Okay. This isn't it's going to pick the stocks that you're going to necessarily buy at the particular time that we're going to buy them, but it is going to narrow it down to the names that you should be looking at. And again, time is very important. Time value is very important. And if you're in stage one, or you're in any stage other than stage two, you're either losing time or losing value or losing both. So in the stage one, as you're moving sideways, you're losing time. You're waiting as the stock stays in a narrow range or even a, maybe a volatile range back and forth, but not making much progress. The same thing in stage 3. You're basically bouncing back and forth and you're in a holding pattern. And stage 4, you're losing value because the stock's going in the opposite direction that you want it to if you're long. Now, if you're shorting, you want to short in stage 4. So the only time where you're gaining value and it's happening quickly is in stage 2. So that's where you want to be. You want to be in that stage 2 and identify that. We're going to give you some rules for that, and we'll get into that in just a minute. But let's just take a look at a few of these names and how the stages progress. You'll find that it's very similar each time. And again, this is a qualifier. This is non-negotiable, what I call non-negotiable criteria. I'm not going to even look at a stock if it's not in a stage 2 uptrend. Like I said, there's a few caveats, and I'm going to go over those at the end here and show you the times where you might stretch this rule a little bit. But 95%, 98% of the time, your stocks are going to be in a confirmed stage 2 uptrend, which means that they need a good 4 or 5 months of uptrend. Again, taking a look at Crocs, this is something that we looked at earlier when we talked about valuation. You can see stage 1, all the action happens in stage 2, a very quick stage 3 as it tops, and then it morphs into stage 4, and that's the declining phase, right? Now, this is Amgen going back between 1989 and 1997. Now, a stock can go from stage 1, 2, 3 into 4, and then back into 1 and 2 again, and you can get a stage 2. Sometimes you'll have over the life of a secular move in a stock, you'll have many times where it goes through these various stages, and you'll have multiple stage 2s. But again, you'll see even as you morph through these various stages, each time the real action is happening in stage 2.
Yeah, and I would say, as you've mentioned, that you want to be in stage 2. And also, there's not just one buy spot in stage 2. Lots of times there are multiple times and multiple spots that you can get in and along a stage 2 move. The other thing I would like to mention is that a stage 2 move in most of these great winning stocks lasts for about 18 months, a year and a half to 2 years. And you can actually see that occurring here on this Amgen chart. From 90 to 92, that was 2 years. And then from, it looks like halfway through 94 through the beginning of 96. So another year and a half period of time. So it's something that you also want to keep in mind, the time factor of the move.
Right. The average length of time that the biggest winning stocks made these moves was about a year and a half, 18 months. Now, Dave, I'm looking at these stocks. Once they turn into an uptrend, then I start looking for bases, and I'm looking at the earnings and sales and so forth. Just curious, in all your years, you've got 40 years or so under your belt of trading. I'm getting close to 40 years myself. Maybe you have even more than that, maybe 50 years. I don't know. A long time though. We've been doing this. In all that time, in all the tens of thousands or hundreds of thousands of trades that you've made. I mean, do you ever buy a stock in a stage 4 downtrend and go long?
No, never. Because you want the odds in your favor. You want moving averages. You want the stock price in an uptrend. You want the moving averages in an uptrend. You want everything going your way. Yes, I'll buy pullbacks, but the pullbacks are small declines of 10 or 15%. But I'm never buying something that is rolling over and is in stage 4.
Right. So you're buying pullbacks within that stage 2 uptrend.
Right.
Yeah. And so this is where a stock would, get on my radar. As it starts to get into that stage 2, it would come on my radar. And then I would start looking for the more specific signs. And like I pointed out before, we're going to look at things from a satellite view. Then we're going to come down from an aerial view, and we'll start looking at specific patterns and technical analysis within the stage 2 uptrend. And then we're going to get very specific and look at the pivot point and the right to the day to buy, and the same thing with the sell side, and look at the earnings, the sales, the margins, and break down everything down to very, very specifics and really look under a microscope. But right now we're looking at things from a satellite view, and this is sort of the first step is to make sure that the stock is in an uptrend. And you can see clearly here, and Dave's what I call my volumeologist. He's really amazing with volume. In this particular example, you don't really have to have X-ray eyes to see what's going on here. I mean, look at the difference in volume on how you've got relatively dormant volume, and then see when you go into the stage 2 uptrend, look at how the volume is just so much more, because that's now the institutions are coming into it. Something's going on here, and they're piling in.
Yeah, and I'd like to add that you're not trying to buy the absolute the bottom of the stock. You do not want to be buying in a stage 1. I always like to see the first move up. How strong is that first move? How many days in a row have been up? How much volume is involved in that first move up? And so, where on this chart where it says on my radar, it's the same thing. I'd look at that first move. I wouldn't be buying there, but I would be buying months later as it came out of about $9 a share, right? Yeah, right there. $9 a share is where I would be buying that for the first time. So you want to pay at a higher price to just let the stock prove to you that there are some big buyers behind in that first move.
Right. I always say you're not looking to get the lowest price. You're looking to get the right price.
Yeah.
So what does that mean? What's the right price? The right price is buying. Your goal is to buy as close to the point at which the stock starts moving in the direction of your trade, because you want to compound. You want to maximize compounding. So you want to know very quickly if you're right or wrong, and you want to time the trade. Timing is everything. It's all about timing. Most of us are looking at the same names. When you've took a bunch of growth managers, we're probably looking at the same 200 or 300 names and narrowing it down to a handful at any one time. The difference is the timing of your buying and your selling. So, this is a qualifier, and I would be here's a perfect example of where I was buying Lulu. And you can see you're already in a stage 2 uptrend, and now you're coming out of a base here, and that's where you get all the action. And then you can see here's where you start to top, and you get into that stage 3 after it's made a good size move, and then it rolls over into the stage 4. You're going to see the same thing over and over. This is basically a concept that I originally learned from Stan Weinstein, and some of you may have read Stan Weinstein's book. At one time, Stan was sort of a living legend, and I had the opportunity to have lunch with him in New York City in 1990, right around the bear market low. I think it was in October of 1990, right to the month of the bear market low. And Stan was a very colorful guy. He was a lot of fun, really awesome. And I adopted this concept, and I've taken it to a little bit further refinement as far as the criteria that I require. Stan's criteria is based on a 30-week moving average, and just being basically above or below the 30-week, and the 30-week being an uptrend. I've added some criteria, and we're going to show you that in just a minute. Let's now taking a look here. This is a stock that this would definitely be off my radar, and some of you probably remember this, and a very prominent and very well-known investor was buying this stock when it came below the 200-day, and of course it didn't turn out very well for that person or for anybody investing in this stock. And this is where it would be completely off my radar. Once a stock breaks below the 200, the 200 rolls over, and it's now in a downtrend. I'm looking to short a stock like that. I'm definitely not looking to go long a name like that. And you can see this stock went down 93% in 15 months after it got below that 200-day and started to roll over. That's, again, you want to be in the 98% club, not the 2% club. You don't want to be swimming against the tide. Just think of it as, would you try to swim against a really strong tide, or would you rather have it be behind your back, or the wind? Would you want to go into the wind, or have the wind at your back? If you were cycling or sailing, this is the proverbial wind in your sails.
Yeah, and to simplify it, and you might have already mentioned this, is that you want that 50-day moving average above the 200, and you want both of those in an uptrend. It's almost as simple as that. Once the 200-day starts moving down and the 50 starts moving down, you shouldn't be in that stock.
Right. And here's some transition criteria to take a look at what you need to see the transition from a stage one to a stage two. And this shows you from a daily and a weekly basis. I'm not going to go over it right now in depth. You have that and you can take a look at that. But sometimes you'll get a stock like, for instance, here's Citigroup. And this is when we had the debacle in 2008. You'll get a transition failure where you'll get a base coming out of a stage one. And maybe even, you know, I mean, this was a pretty nice looking base here, but it didn't really have the inertia, didn't have the momentum yet. So it stalled out and then rolled over. And you can see breaks down, morphs very quickly from stage one, doesn't even get into a stage two and goes into stage four. So you can go from a stage one and then roll over and go into stage four, which, I mean, if there's a previous uptrend here, you might in hindsight take a look at this and it turns out it was actually a stage three. But again, taking a look here, here's Bank of America during that same period. So just starts to get into a stage two right here, right? But can't quite transition and then rolls over. You should be selling stock. If you were buying coming out of this base right here as it turns into a stage two and buying it, pretty early here in a new uptrend, as it can't transition and starts rolling over, you'd be selling stock and trimming your position, or maybe it hit your stop loss and you'd get out of it at one price. But certainly these are key points where you would definitely not want to be in this stock any further than this last arrow here. And that's when, you know, things start really breaking down. Now, I want to show you another name here. This is symbol ANAB. And this was a stock. And just what I want to point out here is that you can have a long turn into a short. And you, in the same name, you might be within the same year or maybe the same name over a period of time. These are actual points at which I bought, where I bought the stock here, sold it here after a nice little move here coming out of a power play. You see, I'm in a stage two uptrend here. Then as the stock tops out and you get into a confirmed stage four and it breaks down, this is where I added it to our short list. And now you see you get that big move down. It's the exact same thing, just basically flipped on its head. So you have a lot of risk here. Once you get into that stage four downtrend, you've got a lot of risk on the downside. And this is where you don't want to listen to upgrades and brokerage recommendations. This is something that I just put on here just to show you. We put this stock on our short alert list right here. And then just a few days later, on 7/9 in 2012, we put on the short list right here. And then on 7/17, just a week later, Citigroup upgrades it to a buy. And then 3 days later, look what happens. Stock gaps down. It's down 23%. So again, believe the chart. Don't listen to Citigroup. Okay, believe the chart. I wouldn't even listen to me or David if we were telling you to go long a stock in a nosedive downtrend, which we wouldn't. So that's not going to happen. But if we did, I wouldn't listen to us either. I wouldn't listen to anybody that's telling you to buy a stock that's in a strong downtrend. And this is a term that David coined years back at the Master Trader Program, and I've been using it ever since because it's awesome as far as the truth behind this. Where what'll happen is when you're in a stage two uptrend, you get a lot of happy surprises. You're going to get gaps to the upside, and you're going to wake up in the morning and there's an upgrade and whatever the news might be, and earnings surprises and so forth. But once you top and you're in that stage four, it becomes, and what Dave has termed a serial gapper. They could be a serial gapper in both ways, uptrends and downtrends, but you certainly don't want a downside serial gapper. And you can see right here, this is another stock that, this is Michael Kors, and when it broke below the 200 here and went into that stage three and started morphing into the stage four, we put it on our short sale list right here. And then look at all the gaps. All these gaps to the downside as the stock just keeps moving down and down and down. This is something that we've noticed for many, many years, that you'll see that once you're in that stage four downtrend, you're really at risk to having a lot of downside gaps.
Yeah, and I would add that in some of the examples that you've shown, this topping phase in the third stage usually lasts at least 3 months, if not longer. It looks like here in this example of Michael Kors, it lasted about a little over 4 months. and then it rolled over. And what's always fascinating by just looking at the moving averages, when a stock is in a stage 2 uptrend, the moving averages act as support. And once the stock starts into a stage 4 downtrend, then the moving averages start becoming resistance. And you can see all the times that this stock tried to rally, could not get anywhere close to that 200-day moving average, and just kept on in a downtrend. So as you've said earlier, everything that was positive on the stage 2 uptrend turns into a negative in stage 4.
Right. So why trade with the trend? Okay. There's a few reasons. The first reason is because history tells us that the grand majority, almost all the biggest winners, the moves happened in a stage 2 uptrend. That's reason enough for me. Okay. You want evidence that institutions are actually in there buying the stock, because you want that power behind the stock. Your buying is not going to move the stock for any length of time. You need institutions, and to get an idea that that's happening, you need to see that trend and get that inertia. So all this is going to increase your probability of success. The real reason, okay, is that, and this is the reason why I have all my rules, not just because they work or they are proven from history and studying stocks and historical precedent analysis, but I want to have a set of parameters that I know what to expect under specific conditions. So that's really the key. The key is to know what to expect and have points of reference. I'll give you a quick story. Some of you might have heard this before. I think I've told it in my books, and I always tell it at the Master Trader program. But imagine you go each morning and you take a train, a 6:05 train to work, right? And then one morning you go to the train station, the train doesn't come in. 6:05, it's not there. At 6:10, 6:15, it's still not there. What are you thinking, right? At that point, you're saying to yourself, okay, it's a little late. It's delayed, right? Okay, so now let's say it's 6:35 now, and then it's 6:45. What are the probabilities that it's maybe something's wrong, that it's not just a little bit late? Well, the longer the time that goes by away from that 6:05, the more that probability increases. Let's say it's 3 hours later now and the train hasn't come in. That's very abnormal, right? The probabilities are much, much greater now, and almost certain that something is drastically wrong. You see, you would not know that, though. You would never know that something's wrong and that train's not coming in on schedule if you didn't know it was supposed to come in at 6:05. That's what all of this is about. All of this is about figuring out what should happen, generally speaking, probability wise, what should happen. And then you can gauge whether it's happening on time or not, and whether the stock's acting normal or abnormal. If it's acting normal, that's great. You want to buy that stock, you want to hold it. If it's not acting right, well, then you'd be selling or reducing. So your goal, again, is not to buy at the lowest price. It's to buy at the right price. The right price is under conditions that you know what to expect, and that are the stock is in a position where it can move as quickly as possible in the direction of your trade and waste the least amount of time, because time is money. Yep. Real quick, these are my trend template criteria, that the stock needs to meet all 8 of these criteria to be considered in a confirmed stage 2 uptrend. So, and all 8 criteria need to be met. If you have all 8 of these criteria met, then the stock is in a stage 2 uptrend. Now, MarketSmith has done something that's pretty neat, and people have really enjoyed using this tool. These templates that I have, the stage 2 template is in MarketSmith, and you can go and this is where it is. You go under reports, stocks, technical, and I have 3 screens that I use. One is the straight 5-month. That's the confirmed stage 2 uptrend. The other is the 1 month. The 1 month is what I call, for looking for stocks that are early turns. I'm going to show you that in just a second. And that's where the trend is only moved up for just about 30 days. And it gives you sort of a heads up, but you also can spot power plays. And power plays are something we're going to get into later, but that's a very strong situation that you want to entertain those stocks when you see the power plays, but they move so quickly that they don't give the trend time to turn into an uptrend. So you still can buy those even though you're not in a confirmed uptrend. And then there's the 5-month wide. The 5-month wide, that allows you to add some parameters, and it doesn't have the RS in there. So you can apply it to some different, maybe if you're a value buyer or some other type of buyer that you want to add some different criteria. You can also use these trend templates as your first screening, your first qualifier, and screen the whole database, the MarketSmith database, and this will narrow down your universe to only stocks that are meeting this criteria. And then from there, you can add additional criteria. There's a
Mark, this is those screens or the trend templates that you just went through is something that I go through on a weekly basis because it can help me spot new groups that are starting to come up, because I also sort by industry group rank within these trend templates to show me which groups are starting to emerge. So sometimes it can also tell you a whole new group move is just starting up, and so
right.
you can use it. You can use it a lot of different ways.
Sure. If you take a look and you look at the trend template, and there's 300 or 400 names in there, and you see you can sort it, as Dave said, by group, and then see if it's dominated by a lot of stocks in a particular group. So yes, there's a lot of ways you can use this. And again, MarketSmith has made it very convenient, and these are my exact trend templates. They didn't like fudge this. They sat down with me and went over the criteria and made sure that it was exactly what I use, and put these together so they're authentic, and they're what we both use. You can see here very quickly there's a shortcut. If you're in MarketSmith, you go to open stock ideas right up here in the corner, and then it opens up right here, and under the William O'Neill screen, you can click on 5-month trend template, and then that will open up. It'll actually go and open up so you can get to all three of them. Okay, so that's just talk, and we're going to also have on a live trading, when we're doing live trading that day, we're going to have Arusha Paris from MarketSmith, and we're going to go through MarketSmith. Dave and I are going to show you, how we screen with MarketSmith. Arusha is going to show you a lot of features on there. Last year, after using MarketSmith and Daily Graph O'Neill products for 30 years, I actually learned some new things about how to use it last year. Arusha showed me a few things that were pretty cool that made my life a bit easier with screening. All right, I want to show you a few caveats now. There are a few times where you might use the trend template, or you might have a stock that doesn't meet the criteria of a confirmed uptrend. One is when you're getting an early turn. That's the 1 month. And you might get a base that forms and the stock is only in an uptrend for a month or two and hasn't had that 5 months. That happens from time to time. And like I said, the power plays, it happens quite a bit. When you get the power plays, the high type flag type action, where you get a quick move, a double or a triple, and you're getting this move so quickly that it doesn't give the trend time to actually turn into an uptrend. The other time, and this recently happened with Netflix. I bought Netflix recently, and some people said, my members of the Minervini Private Access members, I said, wait a minute, this isn't meeting the criteria of a stage 2 uptrend. It was an early turn. Large bases, very large bases that move sideways and sometimes have a big dip on the right side, will have where, again, it doesn't give enough time for the trend to turn up. And these will sometimes come up in the 1 month, trend template. So again, you see a large base right here in Netflix where, see, the trend didn't really get itself turning up yet, but it came out of a pretty good sized base, and here and over here too. I would say though, out of all the trades that I make and I have made, I would say that 95 to 98% of them are in stage 2 uptrends, confirmed 5-month. Dave, as far as the trades that you make and you've made, what would you estimate are the percentage that you have to worry about some caveat and not sticking to the stage 2 uptrend? What percentage are in confirmed stage 2 uptrends?
I would say 85 to 90% of them are in stage 2 uptrends. I do like longer bases because sometimes You get a really good company that has great earnings that has just been sitting out for a while. The earnings are catching up to a previous move. And then you come out of a nice long base. Lots of times long bases create longer moves, but you have to make sure you've got the earnings and you've got all the other characteristics. If it's early, if it's an early stage, stage base there.
Right. And we're not, and it's not that you'd be buying coming out of stage 1 or 3 or 4. You're still in stage 2. It's just you're not in it for 5 months confirmed.
Right.
Okay. Just make sure that you understand that. Okay. So we've gone over the trend. And again, this is just a qualifier. All right. This is really what this is non-negotiable criteria. There's really no, you shouldn't even really see stocks unless they meet this criteria. If you're using the trend templates, if you happen to be using MarketSmith, you're screening with the trend template as your qualifier, you're only going to see stocks in uptrends. So you won't be tempted to buy a stock in a downtrend because you won't even see it. And that's how you want to screen your stocks. You want to put the criteria in there so it narrows it down and you get to a universe of stocks that have a higher probability of success, are meeting the criteria that you want, and that are the criteria that you now know when that train is supposed to come in, right? If that 605 is coming in at 605, same thing here. And that goes a bit further than just this trend. That train coming in on schedule really has to do with the buy point and how it acts after it emerges from the buy point. So we're going to get into that in much more depth as we progress here. So again, we're going to take a break and we'll be back.
Let me add one last thing on this. You're trying to take a market of thousands of stocks and narrow it down to those 10 stocks, those 5 stocks that you want to be buying. And so you want to be very, very critical. And this is one way to just really narrow down the number of names. And then one other thing too, as the number of names in this trend template starts to drop, it starts telling you that, hey, maybe the market is not as good because not as many names are entering into these uptrends. So once you get used to looking at this on a regular basis, it's going to give you a good feel for the market and a good feel for what stocks are emerging as leaders.
Yeah, that's something that Arusha said, that he noticed that, when this list expands, it's a much healthier market. And, when you're in a downtrend in the market and we get these corrections, sometimes there's almost no names at all on it. And then there's other times where there's 300, 500. I've seen, I think, as much as 900 names where, a very, very healthy, strong uptrend market. You have a lot of names. You might say, well, 900 names, I can't look at 900 names. That's why this is just a qualifier. This is just to narrow it down. This is basically your first funnel. And then we're going to go through some more funnels and take it down to where you get down to where you're just looking at that handful of names that are a buy at any particular one time. Okay, so we'll take a break and we'll see you in a little bit.